My name is David MacDonald, and I work at the Canadian Centre for Policy Alternatives at the National Office. So I'm an economist there.
Wonderful. Could you tell us what you think austerity is?
I think the best definition is probably cutting back on government expenditures at a time of slow or negative economic growth. So put another way, it's when things are going bad in the economy that one of the solutions to that problem is to cut back on government expenditures in the hopes that that will encourage economic growth.
So the government is purporting that they don't have enough money for social services and have actually cut back quite a bit. Could you describe what this trend is? Do you think that they actually don't have the money, or what's going on here?
Well, austerity in essence takes three possibilities for a shortfall in government expenditures and reduces it to one possible solution. That solution being to cut government services. Of course, there's three things you can do if your government is not balancing the books. The first is to cut government services. The second is to increase revenues by increasing taxes. And the third is to run a deficit. That is to say, to not balance the books in that particular year, or even for a long string of years, or ever, in fact. And so the austerity school says that only one of those options should be considered, and that is cutting government expenditures. And so in fact, across the board, we've substantially reduced the size of government. This isn't necessarily over the last couple of years, but over the last 20 or 30 years. Governments in Canada, particularly at the federal level, have become substantially smaller than they used to be as proportion as the size of the economy. And so in essence, there's already been ongoing austerity for years. Now there's been more cuts in the last couple of years, particularly at the federal level, where we see in the neighborhood of $15 billion a year in expenditures being cut. And what that means is reduced services for the people that need the most and so on. But the other two possibilities are often far less considered. An increase in taxes, whether that's on the corporate side or the personal side or on the consumption side through things like the GST. And the third option, of course, is continuing to run deficits for long periods of time, which is absolutely something that governments can do and likely should be doing to a much greater degree than they have been in the past.
Some of the trend that I've noticed is as governments are saying they need to cut back on social services, they seem to be giving business quite a bit of money also. So one example is Bombardier actually just got a major subsidy from the Quebec government. And I know your research has actually looked at financial institutions and the subsidies going to them. Could you maybe describe that situation and tell us what's going on?
Well, one of the reasons, in fact, that we have a lot less money to pay for programs now is that we cut taxes substantially, federally, starting in 2000, well, it's been going on for the last 15 or 20 years. If we start the clock, say in 2006, for instance, the last decade, we've cut back across the board on personal income taxes, on consumption taxes, as well as on business taxes. And that reduction has meant that we have about in the neighborhood of $40 to $50 billion less a year to spend on programs or to cover a shortfall in expenditures. And so a big portion of that has gone to the corporate sector, as you suggest. So it's been actually a revolution in corporate taxation in Canada. Most Canadians don't understand that corporate taxes at the federal level have been cut in half over the last 20 years. Just a dramatic change in how we tax in Canada. And the benefits of that have gone to the corporate sector in terms of reduced taxation. Now, the idea behind this, or what was sold to governments by corporations, was that they would take this additional money that they didn't have to pay in tax, and they would put it in expenditures of their own. So they would put it into training their employees, into building new factories, and increasing the productivity of the economy. That was the promise. So we've run this experiment for 20 years to see what will they do with that money. And it turns out that at the same time that corporate rates were going down, business investment was also going down. Remember, that was the opposite of what they promised. They promised to increase investment, and instead of taking that money and spending it on building more factories, improving productivity, they took the money primarily and put it into their bank accounts. And what that's led to is a historic high level of corporate cash. So the corporate sector is sitting on close to $700 billion in cash in their bank accounts, which is actually more now than the federal debt or all of the provinces put together, all the debt from all the provinces put together. So it's an incredible amount of money. And particularly at a time where we have slow economic growth, it's an incredible waste of money, because had governments, instead of giving corporations a tax cut, taken that money and spent it on programs, on healthcare, on education, for instance, we likely would have seen a much bigger increase in economic growth because those resources aren't sitting in a bank account, they're instead being spent in the economy.
And so what kind of consequences do we see then by giving banks these large sums of money and corporations? Is this detrimental to the economy in the long term, or how do you see that going forward?
Well, certainly it's a huge wasted opportunity to provide economic growth. So corporations have been given this money, they're in great shape. So they have substantial cash reserves that they could use at any time to build new factories, train their employees, increase productivity, buy new computers. They can do that at any time. But they've decided not to do that. And because we're unwilling to raise the rates on corporations, at least federally, what that means is that money is out of play. So it can't be used in the economy to increase economic growth. And that's unfortunate because post 2009, the big recession in 2009, we've continually experienced slow growth. So we're not at about 3% real growth, which is what you might expect. The expectation now is that has been reduced to about 2% of GDP, so a huge real decrease in the amount of GDP that we think is even possible from the Canadian economy now. And this slow growth is resulting in a technical recession like we had earlier this year. It wasn't a terrifically deep recession, but it's endemic of this larger issue, which is that we have chronic slow growth in Canada. One of the reasons why is we have big stocks of money that might have otherwise been spent in the economy sitting in the coffers of corporate Canada, and they're unwilling to spend it. And part of the reason why they're unwilling to spend it is because economic growth is poor, and so you get this cycle that we provide more tax cuts to corporations, they decide not to spend that money, therefore we get less growth, therefore they decide not to invest. And so it's a detrimental cycle that I think one of the ways we could get out of it is to increase corporate income tax rates with the purpose of spending that money in the economy, attempting to drive up our growth.
Another aspect of the economy that seems to be quite troublesome is the housing economy. Could you actually speak about that, and what kind of a situation do you think Canada is in now within the housing economy?
Yeah, it's very interesting now. Our debt to disposable income is higher than the Americans' debt to disposable income was at the peak prior to the crisis in the US. Now, the American bubble was based in part on straight out fraud. I think there's a lot less of that in Canada. But that being said, what you need to do to get CMHC insurance in Canada, or insurance on your mortgage, the standards were significantly weakened over the same period as happened to the Americans. We were, in essence, late to the real estate party. And so at this point, we have yet to see a big decline in real estate prices, which to some degree is positive. I'm not looking forward to that. I hope that we do not see that. But I think one of the results of high real estate prices is substantially higher household debt. That's the flip side. Now, much of that debt is in the hands of younger households because they're the ones who came late to the party. So if you had a house in 2000 and you held it all the way through to now, you saw a big increase in your house value at the same time as interest rates were declining. So every time you refinanced your mortgage, it got cheaper and cheaper and cheaper. And so you benefited from this process. So older Canadians will have benefited from this process in terms of increased net worth, although most of that has gone to the top 10% in each one of the age groups. But it's really younger Canadians that have got in late to the market. They have a substantially larger debt, which means that their payments are larger than they would have been in the past. And if and when we do see an increase in mortgage rates, which I think is really what's driving all of this, the people that are most at risk are young households. And what could potentially happen is a big portion of them could be pushed underwater, which is to say their debt would be worth more than their house, their mortgage would be worth more than their house. And that's, while not necessarily a devastating situation in the short term, what it likely means in the long term is that these households will save less for retirement. They'll make different decisions in terms of spending in the economy. So they'll think, well, I'm poor because I have to pay off my debt. Therefore, I'm going to spend less in the economy. I'm going to go to dinner less. I'm going to buy less things in the economy, which is poor for economic growth. And so I think there are a bunch of different factors at play here. And if, economists are often very concerned with government debt and government deficits. But if you are concerned with debts and deficits, broadly speaking, your concern should not be with the government sector, which has substantially lower debt in the aggregate compared to the household sector, which is dramatically higher and has increased substantially since the start of the 2000s. And this is in lockstep with housing prices. So debt is going up because houses are becoming more expensive. You need a bigger mortgage to buy the same house you did 5 years ago. And so I think over the long run, what this is creating is a situation where younger Canadians in particular are heavily indebted, which means that changes in interest rates, particularly even small increases to our already record low interest rates, will be very bad for them. And I think that's the situation we're building up. And it's unfortunate, but we've watched it happen. And so it's a very dangerous situation. And we'll see how it plays out.
In your opinion, is there a way out of here, or is it going to take the market to kind of reset itself before we actually see kind of over the hurdle here?
Yeah, in essence, we've created this problem. We're already, we're like Wile E. Coyote. We've walked off the edge of the cliff. We just haven't looked down yet to realize that we're going to fall. And so one of the problems going forward is that we have already over-leveraged young homeowners. This is already happening. It will continue to happen as long as house prices stay high in Canada's big cities. And so I think the challenge going forward is, can we learn some things from the American housing price decline? There were a variety of programs that were put in place in the American situation that might be things that we could import into the Canadian situation that would particularly apply to young homeowners and helping them to get out from under big debts, to get out under big mortgages, or at least be able to continue to make those monthly payments in the hopes that over the long term house prices will continue to rise. But I think that we've already built up this situation. We can't avoid it now. I think that when interest rates do start to rise, that will trigger the situation. But to date, we've only seen mortgage rates go down and down and down. We're closing in on zero in terms of the Bank of Canada's lower bound of what they can set interest rates at. So we can't go much lower. And so the challenge is, over the next couple of years, where do interest rates lie, and therefore where do homeowners lie?
So going forward, you've done some work with the Canadian Centre for Policy Alternatives on alternative budgets. So could you describe what kind of work you've done with that?
Sure. Well, this is actually the 21st year of our alternative federal budget. This is a project that's been going all the way since 1995 with Paul Martin's famous federal budget and the substantial cuts and austerity actually that were implemented in 1995. That was actually what kickstarted the alternative federal budget. So it's been going for 20 years. It now has, I think this year we'll have 26 different chapters. Each chapter looks at a different area, things like post-secondary education, childcare, healthcare, defense. It looks at each one of these issues. Each one of these issues is written by a different expert in the field, a progressive expert in the field. And in addition to looking at various programs that we might want to implement, we also try to figure out how we could pay for these programs. So there's a substantial tax chapter that looks at different ways that we could change the tax system, increase taxes at the high end, change the way the corporate tax system works, to raise new revenues and fund programs that Canadians want and need. And so in this 21st year, we have about 100 contributors to the AFB. It's a substantial project. We actually hope this year to have it out a couple weeks before the federal budget. And I think this year, in contrast to the last decade or so, there's actually a fair amount of overlap between last year's alternative federal budget and the Liberal platform. And so I think there will also be a lot of overlap this year between our 21st alternative federal budget and the Liberal budget that actually comes out, which may or may not be the same as the platform as it was introduced in the fall. I hope that there are a lot of similarities. There were some good parts of the AFB that were borrowed and used in the Liberal platform, which I think is great. That's exactly what it's for, very progressive pieces. And so I think that's very positive. And so looking forward, we'll continue to use the alternative federal budget as a means of advocating for well thought out ideas that are ready for implementation, and hopefully use them as a menu for politicians to choose from and use in their own efforts so that we can implement programs that help all Canadians.
Could you actually maybe give us some examples? I don't know if you have any figures behind, but like what would be some examples of things that would be prioritized in the alternative budget, and how would it differ from what's being proposed?
Well, one of the things, for instance, we're proposing in this year's budget is free tuition across the country at universities. How much would that cost and how would we pay for it? One of the other things that Quebecers have, but the rest of the country does not have, is affordable childcare. So in Quebec, it's relatively affordable. In the rest of the country, it is absolutely not affordable. And so this year, we're introducing measures that would involve the federal government in helping to work with provinces to provide affordable childcare across the country. The federal government historically has had a role to play in healthcare, but its contributions to healthcare as a proportion of total spending have been declining. Used to be, or the original idea anyway, was that the federal government would provide 50% of the funding and the provinces would provide 50%. The federal government now provides about 15 to 20%. And so in this year's alternative federal budget, we boost that up to 30%. So we're not at 50-50, but we're closer, and we pay for it. And so the document is probably going to have in the neighborhood of 200 pages. And each one of these 25 chapters has 3 or 4 different recommendations that are costed, they're practical policy ideas. And then the tax chapter has costed practical tax ideas so that we can put the whole thing together and pay for the ideas, but also provide a substantially different picture of what Canada could look like. This is fiscally possible. It's not a matter of economics, it's a matter of politics that we don't have a more progressive Canada.